Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of the Chicago soybean complex.
Chicago soybeans. The late July to late August bearish shift pitchfork and a dark blue highlighted October to end November bull channel together made a V-bottom of sorts. However, the move up from this V-bottom was capped in turn by the flatlining short medium moving average, currently at 1332, highlighted in green on my daily chart, and then in early November by the now slowly declining medium moving average in mauve, currently 1344. And after this, in mid-November, by the gold-colored long-moving average, currently at 1375. And finally during November by a band of previously highlighted congestion between 1378 to 1409. All these resistances eventually eroded the move higher, and in the process created a mini head and shoulders top over early November to early December. 2 Fridays ago, the market broke down through the neckline of this head and shoulders top. Now the neckline is highlighted in bright red and is currently at 1352, which was coincident at the time with the lower bull channel line, currently at 1356, plus the 50% Fibonacci line of the late May, early July move at 1349. As you can imagine, breaking 2 trend lines so closely associated with each other as they were back then, as well as a 50% Fibonacci line, required some considerable force. And prices dropped last week to some light congestion from a lesser Fibonacci line at 1312. However, that move was enough to also cause intraday indecision, with daily actions moving from bearish to bullish and then back again to bearish to the 4th degree. Thus, despite a move up earlier this week, back up to the medium moving average, then the red neckline, and then the dark blue broken channel line, well, prices today have ended up back down and around the flatlining short medium moving average. Last week, as I noted the moves lower, I thought it's about time to lay out some potentials below. Now, I will still lay out these potentials, but I'm a little more cautious on the downside this week, and will continue to be until the lesser Fibonacci line at 1212 is dealt with one way or another. Thus, for the mini head and shoulders top, we had a primary target in the 1312 zone, with a harder to reach secondary target X in the 1277 zone. For the bull channel, we have a primary target X1 in the 1301 zone, with a 1308 zone, with a secondary harder to reach target X2 in the 1270 zone. As you can see, the market managed to reach the primary target zone at 1312 for the mini head and shoulders top. However, whilst it has been a significant move lower, it was not wholly convincing. So as I said last week, as a caution, just keep an eye on any retracements higher in case the break lower becomes a false break. Yes, we are still too close to the bull channel for me not to consider calling a false break at some point. Chicago soybean meal. 9 weeks ago, the market started a journey higher, up and away from a late July to late August bearish shift pitchfork that turned into a bear channel of sorts, and up through significant resistances provided by the short medium moving average, highlighted in green, currently at 414 even. Also the mauve colored medium moving average, currently 410. The 50% Fibonacci line of the October 2021 to March 2023 move at 403.60. The gold-colored long moving average, currently 419.30. The more recent 50% Fibonacci line from October to November at 413.60. And the interesting neckline of the old December 2021 to June 2022 head and shoulders top, currently at 439.30, which is highlighted in dark blue on my daily chart. All these became supports. But by late November, the market was testing lower again after establishing a horn top in mid-November, something I'd cautioned about 4 weeks ago. Prices dropped down through all those supports again, and most recently tested down to the earlier support, then resistance and now support again, of the 50% Fibonacci line of the October 2021 to March 2023 move at 403.60. This 50% Fibonacci line had held up prices last week and the early part of this week, but yesterday we had a first close below it since mid-October. And today, though we're not heading that much low, we're also so far not heading high. In fact, we're moving down towards testing the lower end of yesterday's range. This hesitation is something I cottoned on to last week, and I quote, "If this hesitation continues, then it could possibly be seen as a mirror image of the hesitation we saw on the way up back in late October, early November, that ended up being a bullish halfway hesitation. It's too early to say for sure whether this is a mirror image, but I think caution about it possibly being such is appropriate. Thus, if it is so, then you could look for a second leg lower to maybe move down to the 382.5 zone or thereabouts. However, it will depend on what the market does in the coming week, and especially what it does at the three previously mentioned resistances overhead, and what it does at the 50% Fibonacci line below at 403.60. And that's the end of the quote. This brings me to my final point. It's one that I've repeated many times, 27 weeks ago and ever since then. And I quote, "On my long-term monthly charts, 2023 is set up to possibly be an annual key reversal. Thus, if we were to close on New Year's Eve either above 471 even or under 399.10, then we'd be on. Anything in between would have a lesser outside year." End of quote. Right now we are looking at an annual outside year with the possibility of being an annual key reversal down. Now, whilst we still have some time to change that, the sands of the hourglass are rapidly emptying and time is really running out. Chicago soybean oil. The September to November bear channel had been the main driver lower in this market over autumn. The main congestion band between 56.34 to 59.44 was overcome by early October, and prices pushed lower, easily down through the February 2013 high at 54.15 and the March 2013 high at 51.26, though not so through the interesting 38.2% Fibonacci line of the big March 2020 to April 2022 move at 48.95. This surprising support slowed and stopped the market, turning it higher, and 5 weeks ago causing a break higher up through the upper bear channel line and creating a new nascent bull channel, highlighted in bright red on my daily chart. It's currently 51.69 to 56.42. However, this 4-week-old bull channel has run out of steam, capped by the combination of the sine wave, which is highlighted in green, of the declining short-medium moving average, currently at 52.05, and the same February 2013 high support that is now resistance at 54.15. By the time we arrive at this week, prices had broken out below the newer nascent bull channel line, though the move lower has not been that simple. You see, this market now has a choice to either form a double bottom type with this old bear channel and thus have potential back up to the 58 even area, or to break lower below the 38.2% Fibonacci line and form a very extensive bearish halfway hesitation, with the bear channel being one leg and the bull channel being the hesitation, and the potential being as low as possibly 40 even. I am not advocating either of these ideas, not yet at least, but these two situations seem to be the choices the market has right now. Finally, and this refers to an earlier commentary I made a few weeks ago about the larger descending wedge pattern seen at the start of this year. I said the following some 24 weeks ago, and I've done so since, and I quote, "I would consider this descending wedge pattern may, just may, have lately morphed into a possible scallop pattern," end of quote. Now, I will not expand on this idea any further at this time, as it is a big pattern idea, and it is also still early on, but the recent market decline fits in with this idea, fits with the expectations I voiced of eventually witnessing a fall down to the area of the May to June lows between 48 even and 46 even, that zone, which we have just about done. I'm now keeping a close eye on this idea, as any significant break below the 48 to 46 zone could signal the start of this move lower, and likewise any reversion back up to the peak over 66 cents, where we have the head and shoulders pattern in June and July. Well, that could signal the alternate break upwards. Two things to bear in mind. Firstly, this is a really big pattern stretching from November 2020 to today. So do not expect any immediate sharp movements. Secondly, data indicates about 3 out of 4 times the market breaks lower. This doesn't mean that it will be here, but please just be aware of that.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.